While we anticipate positive global growth in the first half of 2025, the second half is uncertain and will be influenced by US policies under the Trump administration and potential Chinese stimulus measures, possibly in reaction to US actions. If the incoming Trump administration enacts policies like lower taxes, reduced regulations and trade tariffs, these measures could be inflationary and impact global growth eventually. China's near-term uncertainties call for caution, but we believe that the long-term growth prospects remain strong. India too remains a bright spot in the long term. Some ASEAN countries are also expected to have strong fundamentals and may outperform China in growth and foreign investment. While 2024 saw the beginning of the Federal Reserve's easing cycle, the inflation outlook for 2025 is less clear, suggesting that the pace of rate cuts may be tempered and the Fed's terminal rate could be higher than initially expected. Despite this uncertainty around the new US policies, earnings will be the primary driver of asset prices. Increased capital expenditure, infrastructure investment, and decarbonization, and indeed supply chain diversification, could all lead to higher earnings in emerging markets. The rise in treasury yields since early October has increased the attractiveness of US-denominated credits. Asian currency bonds fully hedged to US dollar can boost overall portfolio yields due to the carry advantage from a cross-currency basis. Diversifying sources of returns is more crucial than ever, as we expect more volatility. Defensive strategies such as low volatility, dividend income, and multi-asset investing can help cushion against downside risks and contribute to more stable returns. Although the new US policies could pose challenges for Asian and emerging markets, their long-term structural growth drivers, attractive valuations, and the relatively defensive nature of ASEAN markets still offer opportunities for long-term investors. China, India, and Japan could merit standalone allocations due to their unique opportunity sets. Picking the right entry points and selecting stocks with visible earning growth drivers could be key, rather than simply chasing those markets. We prefer high-quality bonds as spreads are historically tight and we're approaching the end of the current economic cycle. With the US having been a significant contributor to growth in 2024, global growth may be affected by reduced US consumer spending from decreased savings and lower wages. Market disappointment over rising inflation, the path of US interest rates, and a stronger US dollar can impact asset prices. Lastly, geopolitical events can greatly influence investor sentiment and should not be underestimated.